Great. It sounds like the sound is okay. I do apologise if it's a little bit crackly. I know that we had some problems yesterday with a little bit of feedback. So do bear with me. Hopefully it will be, or it has been fixed. But if it hasn't, I believe you will still be able to hear me. Things could just be just a little bit more crackly than what one expects. But it sounds like the sound is good. Okay, great. I'm going to share my desktop now, guys, and I'll be back for you in a moment. This is our disclosure, so I'll have to start with that first, guys. But this presentation is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concept strategies and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy. 548.com. This presentation has been prepared without regard to the specific investment objectives, financial situation, and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information or commentary provided. Futures, options on futures, foreign exchange, and other leveraged products, they involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts are not subject to regulation under the US Commodity Exchange Act, and contracts for difference, otherwise known as CFDs, are not available for US residents, and that's due to regulatory reasons, guys, okay? So I'm going to get going and pull up a few things. Well, where better place to start, really? Let us start with cable. Cable's had quite a big move higher today. Sorry, guys, that should be better. Okay. So this is cable. If I just look at today's price action, as you can see, those of you who've had your head in the sand probably won't know that we had a sharp move higher in cable. Best performer in the G10 versus the US dollar by far this morning. Lots of tight ranges persisting, remember. In fact, cable was in a very tight range ahead of this data. Now, this data is all, this spike higher is all on the back of that inflation data. Stronger than expected, we saw inflation in June rise to 1.9% from 1.5%, the strongest reading since the start of this year, and really just makes it easier, one should say, for the bank to raise interest rates. It's easier for the Bank of England to raise interest rates when inflation's at 1.9% than it is at 1.5%. It makes it a bit more comfortable for them. And just kind of adds to that kind of speculation. Now, there hasn't been any immediate reaction in the swaps market, which basically measures interest rate expectations, the market's interest rate expectations. That's still pricing in the first rate hike between the very end of 2014 and the very beginning of 2015. So we haven't seen too much change there. But what we have seen is, what we are seeing right now, as you can see, it's just a bit of stickiness as we got to 171.40. So we had spiked higher. We'd been down to kind of 170.60. That was the low of today, trading in that kind of tight range. A lot of people are expecting maybe some weakness in the inflation data. That comes on the back of some news from the British Retail Consortium, which suggested that shops were actually reducing their prices. So there's a bit of mixed message going on. Apologies there, guys. I was the one that hit the microphone. But a few mixed messages going on. But anyway, it was a better surprise. It looks like it was down to the weather. But again, we've just seen, the pound just recoup that 171 handle. So it took some good data to do it. I mean, we did sell off yesterday. If I just extend this to 2 days, you can see. We had a bit of a sell-off yesterday, kind of in the afternoon. There wasn't really anything driving out. I've had a few different things being touted around, maybe some expectation of weaker inflation numbers, maybe also, political changes. We've obviously had quite a big reshuffle in the UK, but I'd really be surprised if the reshuffle, if the reshuffle cause or politics in the UK really doesn't tend to move the pound. Now, it may do later on, especially with that Scottish referendum, but for now at least, we think it's going to be, we don't really think politics is playing any part in what the pound is doing. And if anything, it probably went to show that, goes to show that, the market is certainly willing to buy the pound on good data. Now, one thing I am just a little bit concerned about is that we've got some very strong inflation data that really plays into the hawkish element of the Bank of England's hands, and yet we haven't really been able to extend gains above 171.40. Now, this could be because the market is not just taking the inflation data on its own, just on its own merit. The market does know more and more now that the Bank of England is also looking at wage data. We get wage data tomorrow. That's expected to be very weak, fall to just 0.5% growth for last month. Obviously, if we get a disappointment there, then that could, again, just drag the pound down again. Just looking at it, if I go back kind of 10 days, as you can see, we're quite close to the highest level that we've been for this month anyway, at 171.80. That's the highest level for many years, in fact. And that we think is still going to act as fairly good resistance. So in our view, if we were to get back towards this 171.80 level, at the same time as we're waiting for some, at the same time as wage data is quite weak, that could be used as an opportunity to sell, and we may just find ourselves trapped in this range yet again. Now, what's going to take us out of this range one way or the other? Whether or not we hit, it's not just all going to be based on the pound side of things. We've got some, obviously the fundamental data is based on the pound. Good morning, Alan. Thank you for joining. But we also have quite a lot of other we also have quite a lot of other factors. Not least of all is the dollar. So, for example, we think that the pound is going to be at risk, or cable will be at risk of maybe declining back down towards that kind of low 170 level, maybe even back towards kind of 169.5, which is the lowest level from 23rd of June. We think that could happen if we see, say, a surprise from Janet Yellen later today, and maybe a boost higher in the US dollar. But we just don't know if we'll see that. It will depend on so much economic data that's coming out, but also primarily on those Yellen comments. Alan, you're saying that you're short cable around 172. Exactly. I was saying 170, 180, 80 to 90 there, I think, is probably a good one. And I think it's probably going to be, I think we're going to see quite a lot of people push to the exits. There just hasn't been any, yes, the pound is looking strong. I don't doubt that at all. I think it's still, got some further upside to go. It's just taking a breather here. And what we've seen, even through this rally in the pound, it's been fairly consistent, but there have been periods, a couple of months here and there, whereby we've tended to move sideways and drift higher rather than really kind of spike higher. And I think that's where we're in at the moment. There definitely seems to be a lot of hesitancy around about this major level, which I'm going to draw in now. Now, this is a very long-term chart. I'm going to just put in my retracement tool here. This is the decline from the bear trend from 2007 all the way down to 2008. And as you can see, around about 173.30 is a 50% retracement of that. That's the major resistance level that everyone is talking about. Stripping technical analysis down to its most basic, you end up having key levels that it's essentially what's the market thinking. That's what technical analysis is. And when the market is looking at kind of 50% retrace, looking at Fibonacci levels and where potentially cable will go next, when we're at these multi-year highs, some of these Fibonacci retracements really take on great significance. And I believe that 173.30 has taken on that. A lot of people in the market are looking at it. A lot of people in the market are exactly just a bit hesitant as we move towards there. So I think cable can overly stretch. I kind of agree with you. I don't necessarily think it's done so now, and especially when you look at this very, very long-term chart, I think you'd see that. But there are just a few warning signs. The fact that we haven't really been able to get back above 170.40, yesterday's high, even though we had that fantastic data, does suggest to me that it's going to be, one step forward, maybe two steps back, the further we go. So that's good. What's my view on Aussie dollar and dollar CAD? Well, Alan, I'm pleased that you've asked that, because I'm going to send you guys something now, which is my piece on dollar CAD, which I put out yesterday. Dollar CAD, which I will talk about, there's a key resistance level coming up, and I'm not comfortable looking for the upside until I get above one of those key resistance levels, which I'll talk to you in a moment. So here we go. Take a look at that whenever you get a moment. By the way, guys, I am looking at Bloomberg charts here, and the reason why is because unfortunately my forex charts just aren't working today properly. So we'll get that back. Now, let's just take a quick look at this. This is our daily chart of the dollar CAD. As you can see, nice reversal there. We managed to hold on to 106. But if I go to a weekly chart as well, there's a few other points that I just want to note, suggesting that maybe this is a bit of a reversal. Sorry, that's not quite how I want to zoom in. Let me just zoom in like this. That suggests that maybe we're experiencing a reversal. So there's, obviously, we saw, the weaker economic data coming out of Canada last week. even though I suppose you could argue that it wasn't that bad. Full-time jobs were created, just overall the economy lost jobs. But this is a Morningstar pattern. It's a reversal pattern. It's you basically looking at it week by week. Remember, this is a weekly chart. So on week one, we had a very negative candle. On week two, that candle has really shrunk. So it suggests that maybe the market is just losing that interest, that selling interest. On week three, we then had a very large candle higher. Now, this isn't the perfect Morningstar pattern at all. It's not, because firstly, if it was, this the third week candle would have been larger than the first week candle, and that's not true. And also the second week candle would have been positive. But life, I suppose, doesn't always give you the perfect patterns. So instead, what we're seeing is that, we still think it's worth something. We still think that there's a reversal there. But if I go back to my daily chart, I still think there's a good argument to say that this is going to move higher. I just maybe think that it's not going to necessarily move as quick as some would like. Maybe as quick as you would like, Alan. I still strongly believe it will retest 108. I do agree with you. You re-entered at 107.18, so you haven't made too much at the moment. We've been hovering around this 30 to 40 level, and that's because there is quite a key level that a lot of people are talking about. And so that's why I think you guys should all remember it. 107.50 is a 38.2% retracement of that June to July decline in dollar CAD. So until, I think, because there's a lot of risk, there's a lot of kind of risk events that could impact this pair over this week, really. We've got obviously economic data coming out. We've got a Bank of Canada meeting. We also have obviously Janet Yellen speaking. So, the market's always going to probably react more to what Janet Yellen says than what, say, the Bank of Canada says. So Janet Yellen is uber dovish, and that weighs on the dollar. I don't even think a dovish Bank of Canada can really save the dollar CAD there. But I would say that if maybe Yellen isn't necessarily as dovish as some expect, she's speaking later today, by the way, then I think we could, easily get above 107.50. Alan, you're saying the Bank of Canada will be dovish. I would argue that as well. We've definitely seen the economic data slow down, and I definitely don't think that the Bank of Canada wants to start getting ahead of the Federal Reserve, for example. I don't think that's on their plan. That's their plan at all. So I think that I kind of agree with you. I think the Bank of Canada will be dovish, and I also think that if we get that with more neutral Janet Yellen, then that could be what kind of sees us back to 108, maybe even back to this. You get this kind of cluster of moving averages. So we've got kind of the 200-day and the 50-day poised. Remember, a 50-day crossover of a 200-day, that can be quite a negative sign, negative or a bearish crossover on the MACDs, on the moving averages. So that's kind of worth just pointing out for it. I think that might shift shape though if we can continue to extend gains. But let me just circle this one for you so you know. It's not that useful, I do apologize, but as you can see, maybe getting above this 107.50 level is going to be your key first target to climb, really. That's going to be the one, that's going to be the level. If we get a daily close above there, I think that's going to be very positive. I'm wondering BSC will cut rate to 0.75%. The market isn't expecting it, I don't believe, but let me just double check. I'll give you the latest from Bloomberg expectations. Remember they're not expecting any change, but I think if they cut rates to 0.75%, then I think that that would be a big shock to the market. The reason why, Alan, I don't think they do that is because if you looked at the labour market data last week, even though obviously the headline figure was bad, there were a lot of full-time jobs created, and that is always a good sign. Now, we did get some disastrous Ivy Purchasing Manager, which is kind of the Canadian PMI. That wasn't great at all. That went down to 46.9. But then we had some fairly good housing starts. We had some house prices are still increasing, so they may be a little bit wary to cut rates in this environment. As I said as well, the headline figure in that unemployment or in that labour market report didn't really give everything away. Alan, you're thinking that Yellen will not be much more dovish from their June conference. I agree with you, but the market does seem to always react to her comments, even if she kind of sticks to the same message. It just kind of almost jolts the market to remember how how rates in the US aren't going anywhere for some time. So I think that's certainly worth worth watching. But you're totally right, Alan. You're stuck between when you're trading dollar CAD this week, you are stuck between the two central banks. So that can certainly lead to a hell of a lot of volatility. But I would, as I said, watch that 107.50. I think if we can, apologies guys, if we can get above 107.51, then that could take us all the way to 108.30, which is a 61.8% retracement of that same move, the June to July decline. And it also takes you then above that 250-day moving average as well. So some key resistance levels ahead of us. But I do agree that if we can get above 107.50, currently we can't. We're just that frustratingly 20 pips below there. But if we can clear it, then 108 certainly looks on the cards, maybe even slightly more than that. But as I said, it all depends on the dollar. Now let's just take a look at the dollar index. I know some of you don't trade this, some of you do. I like to look at it just to get a broad overview of what the dollar's doing. Today it's recovering slightly, as you can see here. A little bit. It had been getting stuck at this 200-day moving average, so we're at a bit of a crossroads here. If we can get above 80.26, we're currently testing that level, the 200-day moving average in the dollar index, and that could be one sign that the dollar is gaining strength. Obviously, it's lost strength this morning against the pound, but it has gained some against both the yen and also the euro. So we'll be watching for a break above that 200-day moving average to maybe get us back to at least 80.5 before we can have a chance of going back to those kind of early June or mid-June highs. They're kind of the levels that we're watching out for pretty closely today. The other thing, that I did want to show you as well, is this 10-year yield. A lot of people have been, very frustrated with what's been going on with the dollar's inability to rally, and that's largely because of this. As you can see, this is the 10-year US Treasury yield at 2.53%, still, just stuck within its range. That's one of the reasons I believe that yields do play into, the strength of the or weakness thereof of the currency. And with US yields so low, that hasn't helped things. So even though we've seen, stock markets rally, for example, even though we've seen, things in the markets calm down, especially after last week's fears about Portugal, we've still seen there's still some residual fear in the market. And so, the 10-year is really reflective of that. Now, just going back to those issues in Portugal last week, maybe those of you will know, there was quite a big sell-off last week in European peripheral debt and stock markets, and it largely came down to this bank, Banco Espírito Santo. It's a Portuguese bank, and its holding company, so not the bank itself, but the holding company, like the parent company, was considered to be under pressure, and potentially on the verge of bankruptcy, and hence big sharp sell-offs in the stock. Stock was suspended from trading on Thursday and Friday. It's got back trading, and it's fallen very, very sharply again today. It's actually at its lowest ever level at 38.5 cent euro, by the way, just to confirm there. And it's and that's kind of just something just to keep an eye on. The reason why is because what we saw last week was that Banco Espírito Santo, its solvency fears, anytime you hear of kind of a bank under threat of falling into insolvency in the Eurozone, there tends to be a lot of panic. As you can see, tons of volume going on here as well. Lots of people ditching their Banco Espírito Santo shares. So what we've seen is, the link between banks and the sovereigns in the Eurozone is still, obviously a key fear. So Banco Espírito Santo shares absolutely fell last week, obviously still are today. Let's take a look at what Portuguese government bond yields are doing as well. Now, Portuguese government bond yields, they have climbed higher, but not in a meaningful way, really. We're only up about 5 or 6 basis points. Last week, if I go back to 7 days ago, we saw a much larger jump, really, all the way to 4%. I think what's kind of interesting is that we never retreated back to those lows from last week. And so there is still a chance that we'd get to 4%. At the moment, this isn't having an impact. This isn't spreading contagion. And there were some people, especially on Friday last week, where stock markets bounced back after that sell-off on Thursday. that were saying, well, actually, Banco Espírito Santo is not that big a deal. It's only got about 1.5 billion of liabilities. The Portuguese government can easily get that. Also in the Eurozone, there's a lot of, the bailout funds are all formalised now. So surely that's not going to be a problem. We would agree with you to an extent, but we still think if the European bank goes down, sentiment could be quite fragile. We have seen the euro decline today, but I don't believe it's because of what's going on in Portugal. I think it's much more to do with what's been going on in Germany. The ZEW, it fell to its lowest level since April, really, which just kind of solidifies thoughts that maybe the Eurozone is starting to cool a little bit. Thanks, Alan, for joining. No problem about having to get off. Good luck, everybody. Good luck with your trading, though, especially dollar cap. So as euro, as you can see, is looking pretty a little bit peaky. It's still in technical downtrend. It's still below its daily intermittent cloud, which I'll show you now. That's a technical downtrend, really, but it's not really going anywhere too fast. 135.70 has been the downside of late. Let me just bear with me one moment. Right now, 135.84 is acting as fairly good support. And below there, you're looking at kind of 134.77, which is the low from February. So going all the way back to here. This low kind of comes, obviously, the kind of lows from mid-June when we were around about 135-ish. We've just basically traded in 135, 137 range for the bulk of the last kind of 2.5 months. The MACD is still kind of trading just sideways, really. There's no real trend that we're seeing here. But I think the threat is always that we're going to cross lower. In terms of resistance, as I mentioned, there's that 137, which is your key level of resistance, which we haven't been able to get above there. However, we do see a bit of a recovery, then we're looking at 137, which is the July 1st high. So this level from here. In the very, very short term, we've got the 50-day moving average, which comes in at 137, 36.40. Which could just slow things down a bit. And then obviously 136.78, which is the 200-day moving average. Now, again, there's that bearish crossover with the 50-day below the 200-day. That does suggest momentum's on the downside. But as you can see, Marion, I think that, 137 is going to act as fairly tough resistance if we are to, send a little bit of a rally from here. Maybe on the back of, say, a dovish Yellen, for example. And if that does happen, I think 137 could really hit things. And we have heard that between 137 and 136, a lot of barrier options are expiring at those levels, and that could be what's triggering this period of tight range, really. If that's the case, I mean, surely it's not going to last forever, one could imagine. But it could certainly explain why. Certainly in the next certainly in the last few days, we've been really reluctant to break out one way or the other. So as I said, support 135.84. That's the 61.8% retracement of the recovery from June 12th to July 1st. If we get a closing break there, then that could open the way to that February low around here at 134.77. But again, on the upside, we'd probably look at 137. And then we'd look at 137.48, which is the 50% retracement of the May to June sell-off. So that's my view there anyway on euro. Should we take a quick look at gold? Obviously, gold sold off very, very sharply yesterday as investors were kind of going, ditching the safe havens. But it has found support, that 100-day moving average, which comes in at 13.04, and is slightly higher today, maybe because we've got some weak economic data. We're also seeing, Portuguese banking sector come under a little bit of pressure, and obviously we're also waiting to hear from Yellen. So dovish Yellen could see us kind of recover, but for now anyway, I think certainly the bias seems to, after that sharp move lower yesterday. There's still a lot of sellers around, and that suggests to me that one needs to be a little bit careful when it comes to gold. I still think there's a lot of people who want to sell. I haven't really been that comfortable with recoveries in gold. I don't think they're typical gold. They're certainly not typical gold bull trends. Even that move from kind of June all the way up to the end of last week. there was only a couple of days where it was really big moves. Usually what you see, if we say, let's for example go back, you tend to see these big moves higher, move sideways, big moves higher. We just haven't seen that. We just really seen sideways movement, which suggests to me there could be further to go on the downside in the very long term. But in the short term anyway, let's go back to our annual chart. Short term anyway, I kind of think 1340 seems to be attracting quite a lot of sellers, especially that kind of sharp reversal that we saw yesterday. We have obviously found good support there, but 1340 and then probably looking around about the 1360 mark. I still don't really think there's too much of a reason to buy gold. Obviously, inflation's coming back in the UK for sure, but I don't think there's massive inflation pressure anywhere. And I think with the Eurozone still so close to deflation, that could potentially certainly keep the downside in focus when it comes to the gold price. But as I said, any move back to 1340, maybe even to 1360 could be used as a selling opportunity. Now, there's tons of earnings out today as well, guys. So do remember, stock markets and everything else get good earnings that could potentially extend recent rallies. Yesterday, intraday, anyway, the Dow made a fresh record high. The S&P was stronger as well. Just bring up that chart. Didn't quite make fresh record highs yesterday, but it does kind of look like 2000 is just on the cards and is waiting to happen. Certainly, right now the tone to earnings data has been fairly good. We do have to wait and see. There's some earnings, for example, coming out later today. That's going to be important to watch out for. But does anyone have any questions? I realise that I've waited on now for 26 minutes. If you've got any questions, I'm very happy to answer them, to look at some charts or look at pairs maybe that I've missed. I never can follow everything. Are there any questions, guys? If there's not, cable. I've already looked at cable actually, guys. Cable top, I'd say probably 172. Any views on the Aussie and the Kiwi given their higher interest rates? Yes, Pan. I do still think that relative interest rate is going to play out in the Kiwi's favour. Let's look at the Kiwi first, and then I'll do the Aussie. Ooh. As you can see, the Kiwi is still faltering around that 88 mark. Some people have, worrying that the economic data is just not strong enough out of New Zealand to really cope with these gains here. I think the RBNZ is certainly trying to talk it down, but not in a massively meaningful way. Now, this does look, like it could be a little bit dangerous and worth watching out for. Obviously, the 86.48 is the 50-day moving average. That is very, very good support. Ahead of this kind of 88 level, you're really having to go back quite a long way. We've already made these highs here, which are some of the highest levels really since the early 80s in New Zealand dollar versus the US dollar, obviously. The other one that could be quite interesting is Kiwi sterling. Just as a relative high yield play, Kiwi has come under quite a bit of pressure actually, obviously today on the back of that surge higher in the pound, trading in a range, and it's tried to break above this range but hasn't quite made it. I think this is quite a good range play if you don't mind, or if you'd like to kind of put one against the other really. 50.09, 50.095 is the 200-day moving average, with kind of looking at around about 150, 170 on the upside. So do watch out for that. I think Kiwi pound could be kind of an interesting one, especially if people are right and they start to think that the New Zealand dollar or New Zealand economy can't sustain these gains in the Kiwi, and at the same time we've got kind of the market still being fairly positive on sterling. That the downside could very much be open, maybe even back to that 50 level, which is the lowest level since February. So do watch out for that. Now, what about Aussie? Aussie's been kind of all around the place really, no real direction. Every time it's tried to make gains, it's really been faulted. And we saw that last week we saw that earlier in July with that sell-off. Right now, it's finding fairly good support there at 93.54. We're only about 10 pips away from there right now. If we get a daily close below there, then that's going to be quite negative. Could take us all the way down, actually, to that 92 level, which is the lowest level since the beginning of June. There's also 92.75, which is the 100-day moving average, and then 91.97 is your 200-day. That's capped the downside in the Aussie dollar really since the beginning of April. So that for me is still, going to be, even if we do see kind of a bit of a sell-off in Aussie, that's going to be the key level, but we're not really being able to extend gains above 95. I think that is a really solid level of resistance. And I think it's because, again, the RBA has not been, the economic data out of Australia has been a bit mixed. Obviously, we do have, really important reading tomorrow, which will be out in the morning London time. That's going to be Chinese GDP. The market's expecting, just double check, I believe it's 7.4%, but I don't want to get anything wrong for you. 7.4%. So no change there, which is roughly in line with what the Chinese authorities would like. Obviously, any weakness there could weigh quite heavily on the Aussie, which is used as a bit of a proxy to trade China. But however, if we do get something that's stronger than expected, so 7.6, 7.7%, that could really help the Aussie just completely rally. And that would get us back towards that 95 level, I believe, in pretty short succession. So going back to the Aussie here, I'm looking at just a daily Ichimoku cloud. As you can see, we're still very much on top of the cloud. 93.32 would look as fairly critical support as well. That's the top of the daily cloud. Remember, a lot of people in Asia look at daily clouds, and a lot of them trade the Aussie. So it's always worth, if you do have access, to take a look at an Ichimoku cloud whenever you get the chance if you're trading the Aussie. But anyway, I hope that helps. So key themes I suppose to look for is that watch Aussie, some Aussie upside if we get a better China data, even though 95 is a key level. I think the pound, I think there's room for a deeper pullback towards 170, 180 maybe. I think that's kind of the other view that I'm taking. And then with the euro, I think that right now we're kind of stuck in a range. If we break below kind of 135.85, then that could open the way to 134.77. And with the dollar CAD waiting for an extension back towards 108 to 108.30, but we have to get a good daily close above 107.5 first. Now, guys, I'm going to leave it there, but thank you so much for joining. As always, really appreciate you guys being there. And good luck with your trading today. Thanks so much for spending the time.